Good morning. Good morning. My name is Matt Sauer, and I'm from Durham, North Carolina. In a 1977 Fortune magazine article titled "How Inflation Swindles the Equity Investor," you argued that corporate earnings in aggregate acted like a bond coupon and thus were negatively impacted by high inflation. Due to high inflation at the time, you posited a world where a 12% return on corporate equity was reduced to 7% after taxes and netted out to 0% in real terms. You have been sounding downcast about the prospects for equities for several years, much of which we assume relates to extreme starting valuations. If inflation was decidedly bad for investors in 1977, isn't the relative lack of it in today's economy at least one mark in the plus column for equity owners? Is there also a future inflation expectation component in your warnings that investors are likely to be disappointed by equity results?
Well, there's no question that the lack of inflation is a plus for owners. I mean, the real return you will obtain, in my view, from owning American business, if purchased at similar prices, the real return will be higher if we have long periods of low or close to no inflation than if we had long periods of high inflation. I don't think there's any question about that, because that article went on to explain how you got taxed on nominal returns and fictitious returns in real terms. So your question is about which period is better for investors. A low inflation period over any long period is better for investors. And the problem, as you pointed out also, was the starting point in terms of predicting modest returns for equity investors. The returns weren't necessarily so modest, I predicted. They were just modest compared to what people had begun to think returns would be during that long bull market from 1982 to 1999. There were polls taken by Gallup, working with, I think, Payne Weber at the time. Now they've moved it over to UBS Warburg, that showed the expectancy of people in the stock market, and those returns that people expected got up to 14 or 15%, as I remember. And they were thinking they were going to get 14 or 15% in a low inflation environment. Well, that was dreaming. And there's nothing wrong in a low inflation environment at all in earning 6 or 7%. That's probably as well it is as good as will happen, because in a low inflation environment, how much is GDP going to grow? Well, GDP, if you have a 2% inflation and even 3% real growth, you're talking about 5% in nominal terms GDP growing. If GDP grows at that rate, over time corporate profits will grow more or less at that rate. And if corporate profits grow at 5% a year, the value of those corporate profits, the capitalized value, will probably grow at something like that over any long term with a sort of a normal starting point. And add that to dividends, and you will get 6 or 7% before frictional costs. Investors incur a lot of frictional costs. They don't have to, but they do. And that often is 1.5%, 2% of their investment. So the math isn't bad. It's just bad for those people that got used to or expected very high returns based on looking in the rearview mirror back in 1998 or 1999. Charlie?
My general attitude is just slightly more negative than Warren's.
You've heard it, folks. That isn't the end of the world. I mean, in effect, if the people who own American business get 5 to 6% of the pie, $10 trillion economy now, someday a $20 trillion economy. But if we get 5 or 6% of the pie, those of us who put our capital out to produce goods and services for American business, for American consumers, American population, is that I don't know whether that's, is exactly what somebody who designed the universe would come up with, but it doesn't strike me as crazy in either direction. I think that That's a lot of goods and services to go to people that put up the capital, and you've got 100 million plus people in the working force that are working to turn that out for you using your capital, and it provides what I would regard as a pretty decent real return if you have low inflation. If you get into high inflation, as I wrote about back in 77, you could easily have the real return to investors get to a very, very low number, and perhaps negative. I mean, inflation can swindle the equity investor, as I wrote back then, and I used 7,000 words to explain why, and we'll be glad to send you a copy of that article if anyone's still interested. But inflation is the one thing that over a long period of time can turn investors' results in aggregate into a negative figure. And it's the investor's enemy. Charlie, does that bring forth any further thoughts?
I don't think you'll get perfect help on these subjects from the economics profession either. They have certain standard formulas. To an economist, when a manufacturing job goes to China, that's just so much productivity increase. And if you ask one, well, suppose all of the manufacturing jobs in America went to China, wouldn't that be a little too much efficiency increase? And their answer would be no. And people actually get paid for thinking like this in major universities.
What would get across the point, of course, is if all the teaching of economics got exported to China, in which that point a new insight would appear.
Okay, with those modest statements, we'll move on to Becky.
This question comes from Mark Jordan in Charleston, South Carolina. He writes, in a period of high inflation, which particular businesses owned by Berkshire Hathaway will perform the best, and which will perform the worst, and why?
Well, the businesses that will perform the best are the ones that require little capital investment to facilitate inflationary growth and that have strong positions that allow them to increase prices with inflation. And we have a candy business, for example, and the value of the dollar since we bought that candy business has probably fallen at least 85%, I would say, 80 to 85%. And that candy business sells 75% more pounds of candy than it did when we bought it, but it has 10 times the revenues, and it doesn't take a lot more capital. So that kind of a business, any business that has enough freedom to price to offset inflation and doesn't require commensurate investment or huge investment to support it, will do well. Businesses like our utilities, which get in effect a bond-like return, but require, if you're going to build a generating plant, it costs twice as much per kilowatt hour of capacity, and all you're going to get is a fixed return, and yields on bonds go up perhaps dramatically if you get high inflation, is not going to do that well in an inflationary period, just because it has certain aspects of a bond-like investment, and bonds generally are not going to do well in inflation. Charlie?
Well, but like our insurance operations, our capital-intensive railroad business is certainly one of the best railroads in the world, and our utility operations are certainly one of the best utility operations in the world. And so it isn't all bad to be up there world class in your main businesses.
Our railroad, the government's talked about building a high-speed rail system in California. I think they're talking about 800 miles of track. And their estimated cost was about $43 billion. And estimated costs on constructions of things like that go up dramatically, much more often than they get reduced even by a minor amount. And of course, we paid $43 billion, counting debt assumed, for a rail system which has 22,000 miles of main track and 6,000 plus locomotives and 13,000 bridges if you ever want to buy a bridge. So the replacement value of that asset during inflationary already is huge, and it would grow dramatically. And the world, our country, will always need rail transportation. So it is a terrific asset to own. I'll just leave it at that.